All right. Hello, everyone. We are just getting started with our webinar today. We'll give folks a minute or so to trickle in. We had nearly 500 people register for the webinar, so I think we'll have a great crowd today. If you would like to share where you're calling in from, it would be wonderful to see where you all are. When I was taking a look at the list, it looked like people were going to be joining us from all over the world. I am calling in today from Los Angeles. See someone from Montana. Hello, Max. Glad to have you on the webinar. It would be great to see Oakland, San Diego, Paris, Norway, Germany. Hello, hello, and welcome. Love to see this big group. Mexico City, Belgium, Cape Town. We really do have folks calling in from everywhere. So hello and welcome. Um, so our topic today is really the investment landscape as we head into 2024. I think this is a really exciting, timely, and important topic that is quite top of mind for all protein startups. My name is Audrey. I am the Startup Innovation Lead at the Good Food Institute. And to share just a bit of background about GFI before we get started, we are an international nonprofit organization, and we are developing the roadmap for sustainable, secure, and just protein supply. To do that, we identify the most effective solutions, we mobilize resources and talent, and of course, we empower partners across the food system. And our goal is really to make all proteins accessible, affordable, and I would say most importantly, delicious. And before we begin today, I have a few housekeeping items. First of all, this seminar will be recorded. We will be posting that recording to our YouTube channel. If you missed some of the great content, don't worry, you can go back and revisit it. We will be emailing, I should say, a copy of that recording to all of you who registered. And we also have some really great previous seminars on our YouTube channel, so I encourage you to check those out. Second, this seminar will include plenty of time for audience Q&A. I know you probably have a lot of questions to ask these investors and experts, and we'll have a lot of time for that. I would just request that you please ask your questions in the Q&A box rather than the chat. That helps us keep track of them more easily. And we do have a bit of a panel in the beginning. You're welcome to ask your questions throughout, and we will sprinkle those in. And I should also really stress that the panelists will be unable to comment or provide feedback on any specific business or any specific company. If you're looking for feedback on your startup in particular, this just won't be the format. So please keep that in mind as you're asking your questions. And with that, it is my pleasure to welcome our 5 investors and experts. We have Steve from Clear Current Capital, Nate from Blue Horizon, Luke from AIM Partners, Matt from Barclays Investment Bank, and Amira from Bluestein Ventures. I think we'll start with a bit of a round robin introduction. If you could all introduce yourself, your background, and a little bit about your VC firm, we can go ahead and get things started. Nate, can I pick on you to introduce yourself first?
Yeah, sure. I'm very pleased to be here. My background includes a time working at the Good Food Institute where I would host these very webinars. So it's fun to be back after about 3 years since I've been at Blue Horizon, which is a multi-stage investment firm based out of Zurich that mostly invests in alternative proteins. We've done about 80 investments in alternative protein companies since 2017. My other background includes working in a biotech incubator, and I was trained as an attorney.
Thank you, Nate. We are so glad that you are back on the webinar. Steve, would you like to go next?
Yeah, sure. And excited to be here. So I'm Steve Molino. I'm a principal with Clear Current Capital, and we're an early stage investment firm focused on the sustainable food space, so alternative proteins, and then other areas within sustainable food as well. And my background is in the traditional finance space, investing in private equity venture capital. And then I have a couple of years of traditional strategy consulting under my belt as well. But excited to be here.
Thank you, Steve. And Amira.
Thanks for having me. Hi, everyone. My name is Amira Khatib. I am a vice president at Bluestein Ventures. We are an early stage VC based in Chicago, investing across the food value chain. My background, I got my MBA from Chicago Booth, spent those few years focused on venture. But prior, my background was in food and marketing. So Bluestein's a really natural fit for me. Excited to be here.
Glad to have you here, Amira. Matt, could you introduce yourself next?
Sure. My name is Matt Spence. I'm a managing director at Barclays Investment Bank. I'm our global head of venture capital investment banking, and then also lead our food technology and alternative proteins banking team. We work with later stage companies as they look towards raising growth rounds, looking to IPO, and looking at exits. Before I was at Barclays, I was a partner at Andreessen Horowitz, trained as a lawyer and have a PhD, and I came to alternative proteins from a previous part of my career working at the White House, at the National Security Council, and the Defense Department, getting inspired by the role of alternative proteins as a broader national security issue. And I'm also a senior advisor at GFI.
Thank you, Matt. And Luke, we'd love to hear from you next.
Yeah, great. And thank you for inviting me. Great to be here. So yeah, I'm Luke. I'm a partner at AIM Partners. So at AIM, we're an early growth fund focused on investing in climate technologies that could address climate change in within the decade. We invest across 4 key sectors, sort of totaling $17 trillion opportunity, of which food and agriculture is, of course, one of those 4 sectors. And we're one of the early investors, especially in the kind of cultivated seafood space and fermented protein space. So my background, 15 years in the impact investing and innovation space, mainly focused on investing in early stage technologies and scaling them. And my background is a mathematician where we focus on climate modeling. So at AIM, I also do a lot of work around thinking about metrics and sort of the climate modeling and LCA analysis of the companies that we're investing in. Great to be here.
Luke. And so I think you'll see that we have a range of investors who are investing at different stages, thinking about different stages of growth for a company, and have different mandates ranging from alt proteins to ESG to food tech. So I think it'll be a really great conversation. So the title of the webinar today was the Investment Outlook for 2024. And before we think about that, we're only 24 days into 2024. I'd really love to take a step back and reflect on what has gotten us to this point, particularly looking at 2023, which felt like a very tumultuous year for all venture-backed companies. Curious to hear what your reflections are on the past year is in regards to the investment landscape, and what do you think 2023 will be remembered for? Steve, do you have any thoughts?
Yeah, sure. It's a good question. When I think of 2023, I basically think that 2022 was the year that basically a lot of things shifted. So it was a very hyped up market up to the end of 2021, 2022, that all changed. And then 2023 was kind of the year where we saw the outcomes of that, because a lot of companies were able to survive throughout 2022 and pivot a bit. But 2023 was the year where we saw the companies that weren't able to pivot as quickly or were not able to ultimately raise future rounds of funding. They started going out of business and things like that. And then also the ones that did exist and did survive, even the new ones, the way they looked at raising money, growing their businesses, and scaling was very different. So a lot of focus on the fundamentals, which I think we're going to get into later. But I think of kind of 2022 of like the year of the reset, and 2023 is like the year of the cleanse, I guess, which is kind of a harsh thing to say. But that's kind of how I think about it.
Yeah, I would second what Steve said, Audrey. I think 2023 really was a year where the easy money of investments really changed. That was an issue of obviously interest rate rising, which increased the cost of investment in more speculative and often riskier investments at an earlier stage. I think second that you saw the IPO markets opening up somewhat in the fall, but wasn't the roaring success that led to a huge rush that allowed a number of companies to realize where the exit might be. And I think a third piece for a lot of these funds, both venture funds and growth funds, is it became more challenging for the investors themselves to raise limited partner capital. And that meant that a lot of VLPs were looking for more returns, more exits, and it just became a much more difficult environment for everyone involved, even though fundamentally the fundamental thesis of alternative proteins, what it could do, remained real. But alternative proteins, I think, became one symptom of a broader reset of the broader investing market. So this is not something that's really unique to all proteins.
And I think I'll just echo, I think what both of you said, with a sort of 40% decline in funding. But I think what we've seen where the companies that have really gone on is the strength of having a strong board and follow-on investors that are able, and life cycle investors to able to support these companies. And they seem to be proving out. But I also just wanted to highlight, we're also seeing, I think, in 2023, more sophistication from the consumers around understanding what the claims are around the impacts related to alternative proteins. And so again, there's probably a necessary cleansing, as Steve says, of the market to ensure that the winners do come to the fore. And I think there are some important trends that did happen in 2023 around there are movements towards FDA approval for certain companies. So there are some underlying trends which will hopefully come to the fore in 2024 as some of these companies are able to then really scale.
Thanks, Luke. Nate, Amira, do you have any reflections on 2023?
I feel like I'd echo what kind of everyone said. I think the one thing I would add, and Luke kind of hinted at this, but I think we all saw kind of the media cycle hitting all proteins very negatively. And I hope, as I think about 2024, is that, maybe we're in kind of this trough of disillusionment and the narrative will change moving forward as we have some of these positive regulatory changes, kind of a cleansing, as you will, as we value consumer trust and consumers get a lot smarter. But I think all this kind of negativity was a bit overblown. And I think that's kind of my hot take. I think moving forward, hopefully we'll see a lot more of a balanced take on alternative proteins specifically.
Yeah, I'd say 23 was the bottom, right, from a VC funding perspective, macro environment, and plant-based sentiment-wise. But just to add, I think that some bright spots are that in Europe, for example, particularly continental Europe, plant-based meat sales continue to be strong all through 23. And I think there's a stronger presence, at least in the early stages of climate funds. And so we did see rounds continue to happen in Europe and government programs that helped companies thrive in that market. So it's not all just the US storylines about plant-based meat sales.
That's a really great point to think about the more global picture. And despite the trough of disillusionment, there are also bright spots, including some of those regulatory approvals that we've all been working so hard for over the last few years. However, you've all mentioned some variation of the word cleanse, and really acknowledging that there was a downturn when it came to funding rounds, and a bit more of a challenging exit environment. Has that changed your investing approach at all? How do you handle investments, kind of given that broader background? And I'll open that up for anyone who wants to hop in.
For us, we've always been pretty disciplined investors. So I would say, we didn't really get caught in the trap of the hype cycles in 21 and 22 as much as we could avoid it. But I think that, as many have alluded to, right now with less capital in the market, For us, that means we've continued to be very disciplined on getting attractive terms, not just for us, but setting our companies up for success as well. I think there's something to be said about having that right valuation and the right terms, and thinking about kind of long-term success in this type of market as you see companies unable to raise their next rounds, kind of growing into valuations, having to do down rounds. So, entry point valuation, very important, and strong fundamentals, knowing companies have kind of the right infrastructure to succeed from the beginning, and a focus on capital efficiency, knowing, again, capital markets are tight. But all of this has kind of forced us to invest with pretty high conviction. And so I think the bar is just a lot higher than it has been in the past. But again, comes back to really strong focus on the fundamentals. And that hasn't really changed. I just think that, again, our bar is a little bit higher than it has been in the past.
Yeah, with like later stage capital in particular drying up, we're not going to get bailed out as early stage investors. We underwriting businesses that have a lot of capex or have a really high valuation at the outset, right? So we have to be more disciplined early on, knowing that that later stage funding was the first to dry up and maybe the last to come back fully.
Maybe adding to what Nate said, I mean, we've spent time raising a few hundreds of millions of dollars for alternate protein companies in the growth stage. And two new things that we've seen from those later stage investors, as Nate said, is first of all, just a real interest in profitability. I mean, growth is obviously important, but not only the high capital requirements, but how do you get the unit economics working? And that's one real change. And then the second piece is to start thinking about, given where a number of those valuations have been, which were quite high, to start thinking about what's a reasonable exit environment for them. And what does the M&A environment look like? Where would it IPO? How do you actually return capital investors? And I think that is true for alternative protein. But again, that's true for a lot of venture-backed companies. So again, I think alt protein companies were another one of the, I don't want to say victims, but another consequence of some of these broader trends.
I think AIM's very similar, I think, to everyone else, in that we're very disciplined in our approach and kind of always taking fundamentals analysis, focus on revenue, etc., and trying to understand how is the unit economics of the companies and how they scale. But I think where probably it's not really a change in strategy, but where we've doubled down within parts of our strategy is also on looking for the different forms of financing that can help them scale. I know Matt mentioned the interest rate environment, but I think we've proactively tried to source and help companies find good terms for debt financing, etc., to help cover the capex costs or inevitable capex costs of the company. So really proactively thinking through that to ensure that they can scale at an economical rate has been very critical to get through 2023.
That's so interesting, Luke, around the debt financing. I'm curious, could you share a little bit more about how you're thinking about that? I have a feeling some other folks on the call would be really interested.
Well, in terms of, just working with our companies, obviously both in board capacity, etc., but a lot of them were getting term sheets at one point, especially during the glut of capital, and this is helping them realize actually to take the terms, because seeing that the capital wasn't always going to be there, especially at that level of cheapness. So sort of helping them secure at the time that's needed. And then it's been a conversation ongoing with the companies around how they could use different sources of capital as it comes along to scale, and having the runway to do that. So that's the approach we've taken.
Yeah, and just to add on to that I was going to mention something similar to Luke, but it was less on debt financing, but more just in terms of like non-dilutive financing. We've also been focused on that, and I've also seen the founders focus on that more, which is a good thing to see. So beyond debt, there's also like equipment financing, which it can be very, very helpful. And then also we've been put in touch with a couple of firms that basically help startups map out the non-dilutive grant financing space. They help map it out, and then they could also potentially help you actually apply for those grants. But again, I think the exciting thing is that a lot of founders I'm talking to now are already proactively thinking that way. So instead of thinking of a $10 million equity round at Series A, they're thinking a $10 million round, but maybe 6 or 7 of it is equity and a couple million is through non-dilutive financing.
Yeah, just adding to that, I think, I mean, one of the non-dilutive financing that I think has become interesting is some of the government sources of funding. So obviously traditional meat is highly subsidized. So it's not really working in an economically free market way either, if we're being very honest about things. So the Department of Energy Loan Program Office, I know, had put out guidance to talk about alternative proteins would be of interest for these loans that are non-dilutive, just need to be repaid to the government at a pretty attractive interest rate. A number of companies have applied. There are other sources in Europe that have looked at the same. And then also strategics have also been an interesting source, which has kind of come down. But the ADMs, the Tysons, the other sources like that, to not just add capital for longer term reasons, but also some of the strategic partnerships, which I think become more important in this really constrained fundraising environment.
Thanks, Matt. And I just wanted to bring attention to Molly's posting in the chat. GFI did host a webinar with the Department of Energy Loan Program Office. We recorded that one as well. And so feel free to go ahead and check that out if you're interested in learning more. There are certainly some really interesting opportunities out there for all protein companies. And I know earlier, Amira, you mentioned that there was a lot of negativity around alt proteins in the news, some mentions of the trough of disillusionment. How would you say that the media influences your investing? And I guess I'm just curious, do you see that being a challenge more with attracting generalist co-investors who might be more influenced by the media environment? Curious as to how you all are thinking about that.
Yeah, I mean, I'll step in on this one. I think it doesn't necessarily influence my viewpoints or the theses that I have around where I want to make investments, but it does put a lot more emphasis on the importance of the team that you're backing, and do you feel that they have the right mindset around how they're going to approach responding to things if some of that negative attention gets put in their direction, because that's a skill set in and of itself, and it's not until you're at basically the growth stages or later stages that you'll have the capital to have a PR and communications team. So in the early days, it's going to be really fielding those types of questions yourself. But we have gotten a lot of inbound on that from our LPs, so the investors who back us, where if they see something, they'll reach out and ask a question, and rightfully so. We're stewards of their capital, right? So if they see something concerning in an area that we may have exposure to, then we welcome those questions, and we get those sometime. And then on the generalist investors side, co-investing in the space, that definitely impacts them. But at this stage in 2023, 2024, there's just less generalist investors focused on the area for the time being.
Yeah, definitely fewer generalist investors to co-invest along with. And I think also important to point out that our LPs read the Bloomberg and WSJ, so we need to be aware of what's said there. And there is useful criticisms in there that we need to at least factor in, right? So maybe that help make us think more about how healthy are these products, and we're going to look a little more in depth at the ingredient deck on a company, right? So it's probably an overreaction, a lot of that information, but it's good to at least be aware of it and take some of it in.
Absolutely. And I guess along those lines, what are you all looking for in the companies that you're investing today? Are there certain things that make you kind of sit up a little straighter as you're going through a deck? And just has that changed at all over the last few years?
Happy to kick off. So at AIM we only focus on fermented and cultivated protein. So we've avoided plant-based so far, and mainly that's because we're focusing on solutions that tackle taste, texture, nutrition. So out there, so in terms of what we're looking to invest in, is anything that kind of solves where the gaps are in that market. Historically, we focused on seafood solutions, kind of solving for the 100 million ton supply demand gap that's sort of forecast to happen over the next few years. And again, solutions that can really tackle that, as well as targeting, looking beyond kind of the US and Europe, but also the global South. 3 billion people rely on fish as a protein source. So it's kind of anything that kind of solves that global issue is where we're really interested.
Fantastic. So nice to hear that you're focused on that massive seafood market. Amira, do you have any thoughts on this in terms
Yeah, happy to jump in. So we invest, as I alluded to earlier, across the supply chain. So we look at consumer products you might find on the grocery store shelves. We look at the future of commerce within food. We look at food tech, not just alternative proteins, and then we look at software enabling the industry. So we have a pretty broad mandate with the scope of how can we make the food system better, healthier, and more sustainable. I think that's helpful context for what I'm going to say, which is I think for us, kind of going back to delivering returns to our LPs and thinking about kind of exit horizons. On the food tech side, more broadly, I think it's become important for us to think about, how can this company get to revenue at an earlier stage? Because when we're thinking about our portfolio construction, having like 7 companies in the portfolio that are not going to get to revenue for, X amount of years is kind of challenging from a portfolio construction perspective. And so getting kind of early pilot partners that are willing to pay for your services and getting to revenue a lot earlier, I think it's been something that's really attractive to us. Obviously was important in the past, but I think on the food tech side has become ever more important these days.
Yeah, absolutely. I feel like that mirrors some other comments around, that path to profitability really needing to be much clearer now than it was before.
And a phased go-to-market strategy to go with that, right? Like, I don't want to be told that your target market is dairy or beef or something, right? You need to have like intermediate products before you can get to any kind of scale. And yeah, get some of that revenue in to take the pressure off on the fundraising side as well.
Got it. And sorry, Nate, just to make sure I'm understanding, so you want to see folks focusing more on specific product categories versus the entire beef market?
Well, if let's say if you just have a plant-based company, like have a product that appeals to a specific consumer and not just like a generic meat alternative where you're going to appeal to the flexitarian market because it's not really like a consumer segment. And then say you have a biotech company and you want to produce casein, it's going to take years and years before you can produce a bulk protein like that. So what can you do in the meantime to bring in revenue and prove your technology works and all of that, right?
Thank you for clarifying. Steve, do you have any additional thoughts?
Yeah, I mean, you could talk all day about what we look for in companies, but I guess the only other thing I'd add right now is I put a lot of scrutiny on the amount that is being raised and is it the appropriate amount? I mean, we've always done that, but in prior years, sometimes money was just easier to come by. So you're able to raise bigger rounds and kind of have a bigger buffer for what you need it for, plus some extra. I really like to see the founders and the founding team who have put legitimate thought into exactly why they're raising the amount that they need and what it will get them to. And will those milestones all be met? Most likely not. And sometimes milestones change and they should change for the best interest of the company based on opportunities that present themselves. But at the present, I like seeing more than just we're raising a certain amount of money, 20% towards R&D, 30% towards personnel. I like to see it more granularly built out so that I understand that they're really thinking about what's the best use and most efficient use of their dollars.
That makes a lot of sense. And, shifting gears a little bit from that, in terms of the amount of money being raised, we were hearing about some very high valuations across the board in all venture-backed startups, and particularly so in alternative proteins. And, I've been hearing a lot about valuations falling down, investors really waiting until there are those more favorable terms for investors. How are you all thinking about valuations in this environment? I know that might feel a little different maybe at the earlier seed stage side. And I guess also for you, Matt, how are you thinking about valuations just given the broader perspective on the venture-backed environment?
Yeah, maybe I'm happy to start. I think the broader sense of valuations, as I said, is just you've seen a number of very prominent companies come down in valuation. Everything from the Stripes to the huge leaders that just raised at very, very high levels and then have come down. And I think that's because the IPO market has been pushed out. And I think in the M&A environment, a number of large acquirers are waiting for the valuations to come down. So I think that's the one piece. I think for alternative proteins, it's challenging because when you value a company, typically you try to identify some regular comparables in the public market. So if you know a cybersecurity company, you can look at CrowdStrike or Cloudflare, any number of those. In the alternative protein markets, there's Oatly and Beyond. And I think a lot of earlier stage alternative protein companies make the case that they're closer to being a synthetic biology company than a consumer goods company, which trade on very different revenue multiples. So when you're trying to think about exit multiples, it's harder because the traditional tools of valuation and comparing companies to what's out there aren't readily available. So you're still telling a story about how you think you can get there, how the market's going to improve, how capital efficiency will prove itself out. I think one thing that has been challenging right now is, I think Nate and others said, there's high capex requirements in alternative protein. Take just cultivated meat, for example. And I think there's a lot of understanding around how that happens. What's been even more challenging now is even if you take aside that these are capital intensive businesses, like a lot of other things that we need to improve and run the world are, the margins continue to be very difficult. And so the question is for a number of these companies, how do you move the science from amazing products that are technically sophisticated breakthroughs in the neighborhood of flying cars into something where we can reach a point to say, okay, here's when every new unit you sell will actually make money, or at least not lose the huge amounts of money that they often are without some form of government subsidies. And I think that is really the question that I'd be looking for most this year. Which are the companies that can answer that question? And I think those companies that effectively can, whether it's cultivated, precision-enabled fermentation, or plant-based, are the ones that are going to see more success when they're out in the growth markets.
Thanks, Matt.
And I would echo everything that Matt said. And I think that while for investors like myself, Nate, and Amir, who invest at the very early stage, while exits are very far in the future, a lot of the valuation approaches, at least that we take, is you start from the end. What do you think that this could actually turn into? And then you back into how much money will they need to be raising over the lifetime of that investment, back into revenues that could ultimately be happening during that time. And you figure out what entry point makes sense for the given level of return that you're looking for. And there was a mismatch for a very long time. And I think it's because what Matt mentioned, where people were looking at, two things. One, they were looking at what was out there. So like Beyond, which at one point was trading at I think 35 times revenue, which just makes no sense. CPG companies traded 1 to 4, 1 to 5 times revenue, maybe. So just there was a mismatch there. And then even a lot of these companies were just saying that they are the same profile as that when they're not, when they might just be an ingredient company, which trade at 0.5 to 1.5 times revenue, or even lower. They could be on EBITDA margins, which are even less attractive, or EBITDA multiples, which are less attractive sometimes. So I think what we're looking for is that two things. One, the entry valuation makes sense for where this company reasonably can grow to. And then two, that it's not overly dilutive. And that's a hard thing to find the balance between, just because some of them need to raise decent amounts. So you don't want to buy too much of the company early because that's going to shoot the company in the foot in the later stages. So there's a lot to take into account, but it's shifting in a more reasonable direction over the past couple of years.
I think echo what was just said, and the only thing I would add is, you know, in my opinion, the best founders understand that you do need to give up some equity, and you're getting valuable partners on your cap table, and it's great to be reasonable about your valuation expectations. It saves you time. You'll find the right partners who are aligned. And again, it sets you up for success in the long term. Not saying you need to give up a ton of equity and fully dilute yourself, but I think it's important to go into fundraising with reasonable expectations, because you just end up wasting less of your own time and setting the business up for success. And I think in the last, year or so, the best founders understand that. And I think the challenge is, as a founder, how do you kind of set that up from the beginning and again, just have those reasonable expectations.
Maybe
Absolutely.
that prompted one thing, Audrey, maybe a more controversial question is, I've been talking a lot about the growth market and exit environment. In these downturns, be it early internet bubbles or others, oftentimes the seed and early stage environment of investing doesn't really change just because you're making some of these early bets. For you, is that true right now? I mean, because if you want to have the great exits in 5 to 10 years, you still need to be pretty active now. Have any of these broader trends really impacted what you're doing at the earlier stage for some of the other investors on the panel?
I mean, it's made us a lot more aggressive on the good deals. I'll say that.
I think there's been a major slowdown in terms of number of deals from what I've observed. Probably more of a symptom of like a lot of the generalist investors falling out or funds not raising follow-on funds, and when LPs are more focused on bond market purchases or whatever it is, right? So I think it definitely has impacted the seed investing space in alt proteins from what I can tell. But maybe like it's not all about valuations, it's just about deals not even getting done.
I would just add too, because we look across the industry, I would say on the food tech side, we see much more reasonable valuations, because you have mostly institutionals who are focused on investing in this space who have stayed. For example, which doesn't impact most people on this call, but in the CPG space, you actually see that valuations have not come back to a reasonable level because you have a lot of non-institutionals, whether it's influencers and celebrities or angels that just don't have the same kind of knowledge of what's required in the venture market and aren't as price sensitive. So I've actually seen a lot more reasonable valuations in food tech over the last year than I have in CPG, which has led us to invest a lot more on the food tech side, candidly.
That's so interesting, Amira, because I feel like you have such an interesting perspective given that broader focus on food of Bluestein Ventures. And I'm curious, are there other areas, we've talked about revenue multiples being very different in food. Are there other areas that you think alt protein founders need to be aware of or focus more on in order to be competitive in the food industry? And that's something I've just noticed across alt proteins, is that of course there's a lot of technology and a lot of science that goes into these companies, but ultimately at the end of the day you're selling food, which has very low margins. I'm curious, like, what do you counsel your founders about when it comes to being in the food industry?
I think some general comments. I think we've seen a lot of going back to the multiples point and sort of how it ties to their market strategy, because so for instance, seen a lot of companies that maybe start as an ingredient company, but then pivot towards being a non-ingredient company producing an actual product because those multiples are higher. But I think, sort of going forward into 2024, having that clear market strategy and how they're actually going to get their product into market, and then also tie that to valuation and being consistent with that, is something we're seeing more and more as being really critical to to understand essentially that sort of then flows into how much capital they need, the CapEx model, to get to revenues. And then also, where are those revenues coming from? So, we're placing a lot more emphasis on those long, multi-million or multi-year contracts, which can actually really create the scale of the company, 2, 3 years down the line, as they kind of meet milestones, as they're able to scale with those companies, versus sort of very fragmented, sort of ad hoc selling into different markets. And that we're seeing is very necessary to just to show that there is actually the scalability there. Yeah, I'd say those are that's probably the kind of one of the big pieces that we've seen happening.
Yeah, and I mean, I think Audrey, you kind of hit the nail on the head of like what we try to get our founders to understand, which they generally do. Like I want to make that clear. Most of the founders in the space are pretty smart. Like they understand what they're building, but from a storytelling standpoint and how they position themselves, and even that sometimes that the expectations is these are food companies. Most of them. Some of them are B2B enabling technology companies, and they are not creating food. They might have a software or hardware that helps these spaces. Those are different conversations and different stories. But a lot of these companies are food companies. So maybe you do have really high tech to create a novel ingredient, but the selling of that ingredient, the prices, the margins you need, the distribution, and everything that's required for getting an ingredient or a product out in the market, that's pretty traditional. So focusing on the business that you're actually creating and using a lot of the best practices from that industry is honestly like that's the way to go.
Thanks, Steve. Anyone else want to chime in on this before we move on? Great. Well, I'd love to start thinking about ESG or talking a little bit about ESG investments. I think we all noticed there was a rush of capital into ESG. BlackRock was, very famous for the focus that they had on that space. But now it's all over the news. I think I was just looking at the Financial Times yesterday, reporting on investors really scaling back their ESG investments. What do you think this means for All-Proteins? Will this have a noticeable impact on the space, given the positive ESG contributions that All-Proteins make? And Luke, as an ESG investor, maybe you've done some more thinking about this, just to get your thoughts.
I mean, as I mentioned, right, we focus on solutions that can scale within the decade, and so therefore being actually able to sell a product and generate revenues, you can't have impact without revenues. But we are seeing, I think, as I mentioned earlier, that the market, say within continental Europe, that is still growing. UK. So although there has been some conversation around ESG, it's still very much a driver for consumers adopting this alternative protein and wanting to buy it. I think where a lot of the consolidation in the market has happened, the bar's rising on if they are going to buy it for health reasons or environmental reasons, then they need to know those claims are true. And that's what's, I think, driving where people have been out putting capital. They're being more cautious on which companies to invest in, because they want to know that what they're investing, if it is going to be because of an ESG reason, that is those claims are real. I mean, from Amy's perspective, and we spent a long time doing deep dives on the sector, understanding the claims, understanding the technologies, and that's what's ended up why we have a very specific focus on which technologies we're supporting and what type of companies we're supporting, what sort of product offerings we're supporting, because we want to make sure that those claims are there. And I think also unintended consequences are becoming a much more bigger conversation. So it's not just about emissions, but how they fit in the wider ecosystem. But yeah, we are seeing it as being still a core driver of investing.
And Matt, what are you thinking, or what is Berkeley's thinking about this scaling back of ESG investments? Is that a broader, just curious as to what the broader conversation is around that?
Yeah, it's a really good question. I mean, from our standpoint, we're still very all in on ESG. We just announced a new investment banking team, which is around the energy transition. And of course, energy transition is not just about distributed power and energy, but it's about food and agriculture as well. Though I will say, separate from what Barclays' view is there has been a real change in there were a number of funds which had allocations either from pension funds or universities or other of their investors, which needed to go into ESG-oriented investments. And there was an overbalancing around energy and electric vehicles and chargers. And obviously, as we all know, given the huge climate impact that animal agriculture had, this was a great sector. I think we haven't yet seen that bear itself out in the investment area yet. We've seen the asset allocators pull back a bit. And unfortunately, I think this is something we're going to need to watch carefully because there's not as much potentially this allocated set of capital that knows to save the planet, you have to invest in capital intensive activities. I mean, a lot of people wish we could save the future of the planet by cryptocurrency, the blockchain, and enterprise software. That's just not how it works. People need to eat real things. They need to drive actual cars. They need to do things. And so this is one thing that you could probably ask us next January, Audrey, is what did we reflect on 2024? And if these trends, which we're reading in the New York Times, the Wall Street Journal, and Financial Times every day, have actually borne itself out.
Yeah. And I would just add on kind of the drives of where money is going. Although there's ESG reasons for why some of these are allocating, it's also say there are supply chain shortages on some of the sort of protein sources, and that's also where capital is still going. So I mentioned like the seafood shortage, which is happening, which is related to ESG, but not necessarily its niche in its own right, and that's driving up prices and enabling adoption of new technologies. So I mean, I think when there's more factors beyond just being ESG, that's where more the capital is flowing.
Thanks for that, Luke. We have a lot of amazing questions coming through the Q&A. Just a reminder to folks, if you have a question, please ask it in the Q&A box. It really helps us keep track of all of them as they're coming. So I'd love to switch over to some of these audience questions. In particular, we have quite a few around some diligence metrics, company performance, and so I would love to get all of your perspectives and thoughts on some of these. The first one here is around timelines. Specifically, has your view of timelines, kind of what that takes in order for a company to mature, has that changed? Do you experience pressure from your LPs on rapid product development and market entrance? Or do you still think that there's tolerance for some of those longer term horizons? I know for many of these companies, especially the ones with really deep tech, there's quite a while before they really have a product on the market. So I'm curious to hear if that has been a challenge for any of you as it relates to your LPs or your investment decisions.
I mean, I could opine on that. I mean, we don't really get pressure from our LPs. I mean, at the end of the day, like we're structured like a traditional venture firm, so a 10+2 structure. So 10 years to invest and exit companies, and we could extend by 2 years. At the end of the day, that's really on us to hold up to that promise, that legal promise to our LPs. So it's not necessarily LPs questioning the underlying investments if it fits the timelines that they need. And but as things develop over time, that'll be on us to make sure that we can stay true to that promise and agreement that we have. I mean, the timelines for us, that the way that we do think about it, though, is that like we have a specific period of time. So if we just raised a fund, for instance, and we have that's the longest period of time we'll have to wait on something, then it's probably more likely that we'll do something in like the synthetic biology space that has a lot of R&D timeline, maybe takes a little bit longer to start generating revenue and growing in the traditional sense. And we'll have less of a hesitation to invest in something that's less R&D or synbio focused as we're nearing the end of our investment period, just because those have more traditional timelines. But yeah, that's kind of how we think about it.
Thanks,
Yeah, I
Steve.
think Steve kind of hit the nail on the head with how we think about it as well. Pretty much all aligned on everything he said, but I would add that we also, which I kind of alluded to earlier, because we aren't just looking at kind of deep tech investments, I think we also have an eye towards how many investments are we making that kind of have this longer horizon versus how many are we making that may have a shorter exit horizon, and kind of balancing that with our portfolio construction strategy. So I think that's kind of not just our fund, kind of where we're at in the fund life cycle, but also just kind of from a portfolio construction standpoint, how many of these are we making? But no,
Thanks, Steve.
just to answer your question, I don't think that pressure is coming from LPs. It's up to us as fund managers to, you know, have our own strategy that meets that timeline.
Awesome. Thanks to both of you for answering that. The next question here is around runway. This person, Ryan, understands that in the frothy days, startups were raising about 12 months of runway. Now it looks like it might be 18 to 24 months. Do you have any thoughts on that as we head into 2024? Is it better for folks to raise more runway? Are you seeing that more commonly now? And then kind of an associated question is he's asking, is our SAFE still the preferred route, or are people moving back to more traditional forms of equity? So I realize there's kind of a two-part question there.
Yeah, happy to kick on the run rate point. So yes, I think there's been a lengthening of run rate, but also increased discipline on how people are actually spending the money. So it might not be necessarily raising more. It's the expectation that they'll they'll be more scrappy and be more disciplined with how they're actually spending the money. And that's become increasingly important. And I think someone mentioned earlier on one of the previous questions of, what milestones can they actually achieve with that funding, and how it might go to market. So then that's kind of where the world is. So yeah, there's a lot more focus on bringing cash burn down, the spend, unnecessary spend, and be really clear about your kind of, what you're going to achieve with it. Yeah, so I think that's what we're seeing.
Are other folks experiencing that same thing with the expanded runway, less budget?
Yeah, at least have a plan probably for the 18 months if you need to extend your runway and reduce your burn. And I just want to say on the second question about equity rounds versus safes, I think I don't think anything has really changed there from my perspective. Equity rounds are always probably preferred from the investor perspective, depending on how it's negotiated and what the protections are. But just practically speaking, a safe is so much faster to get done. So if you're interested in just moving quickly, or if you're like a volume investor, like an incubator, that's just always going to be so much faster. If a company just says we're raising a safe at a reasonable valuation, come aboard if you want. That's always going to be more efficient, I think.
Great point around that speed factor. And, what's come up a few different times is this idea around raising less money, having a tighter budget. And someone's asking, what are the areas that you think companies are kind of cutting to reduce costs? Is it R&D, people, facilities, outsourcing work? Are you noticing any themes there?
I mean, an easy low-hanging fruit one on that is there was a period of time where a lot of companies were trying to do a lot in-house in terms of manufacturing or having their own labs or things like that. That has shifted considerably away. So a lot of CMOs or co-mans, depending on the space that you're in, that they're being used, or again, I kind of mentioned this before, but like equipment rental or financing as opposed to outright buying things. And then I am seeing a lot of companies now using a lot of contractors work versus hiring people full time, which I actually have always liked, not necessarily because of the cost standpoint, but it's a really good way to find potential talent that might be an awesome fit for you at like long term, and you could ultimately try to bring them on full time if they're just stellar. And then also if they're not working out, then there's not some long employment agreement that you have to worry about firing someone, or did you offer them equity or something like that. But those are like the key areas that I think companies are kind of scaling back a little bit.
And do you think some of that ability to outsource, is that due to the entire, in addition to kind of having a increased focus on budgets, do you feel like that's also because the industry has been growing and all these associated services are maybe now more available to companies than they were before?
Depends on the space. Like in the plant-based space, those services existed always. So it was a big vote of confidence in yourself if you're building out your own manufacturing facility and doing that. And some companies did that well. So it's not like that's the wrong path. We tend to advise against that in the earliest days. But on the synthetic biology side, so precision fermentation, cultivated, et cetera, definitely now there is more of an ability to outsource some of that when first, depending on the needs, it didn't exist at all or in the earlier years. So that's definitely part of it.
Got it. And moving along, someone else here, Stephanie's asking around how do you support founders and executive teams? And the context of this is around, having a company is really challenging. At least maybe in the earlier days when there was a lot of funding, founders could kind of pay to maybe cover up their mistakes as they were growing into leading a company. Now there might not be as much funding and money to hide things. Does that change your founder relationships, or how might you be helping or supporting them in a different way, given this evolving economic background?
I'm happy to jump in. I don't want to talk too much though. So if anyone else wants to, feel free. But we are obviously helping a lot more with fundraising. So when money was easy, we would still always support in that area, but we didn't have to push as hard. But now the discussions, there's a lot more of them, but it's also, I think they're better. They're better for relationship building with our founders, because it's not just making intros, it's also helping them figure out what they should be, like what story should they be telling, what should the next milestones be, which I think it's part of our job as investors to know what the later stage investors want to see at different stages, so we can help guide the milestones for the company. So those conversations are happening more often now. But that's like the biggest key change, I think.
I mean, I think there's a point where you want to be raising when you don't have to raise. So I think given this environment, because diligence has taken longer, you're seeing some of these processes for growth rounds going from a few months to almost a year now. So when you have opportunities to join things like GFI puts on, even informal ways to start getting to know investors, that's a much more helpful way to tell your story, have them taste your product before you're actually launching a fundraising round. And I think that's always been some piece of advice, but that's particularly true in this environment where things just are taking longer and you need to be patient. And if you wait to raise until you're at the barrel of a gun, when you only have a few set period of runway left, that's when companies really start getting into trouble.
Yeah, it definitely makes sense to plan ahead.
I was just going to add, we're also definitely advising and supporting with more and more bridge rounds. It's just a way to get money in more quickly and hopefully be raising your bigger next price round in the 2024, 2025, when we expect the macro environment will be better. And also just letting them know, we're not upset if you're raising a flat round or a down round. Like, you have to make difficult decisions, and maybe you're shutting down R&D projects and we're going to get a little bit diluted, but just have to create that base for the future.
Yeah, I would echo that. I think, I don't think that's a change per se, because we've always been very active investors, board roles, etc. But I think where the conversations have shifted is this focus on, trying to streamline R&D projects, not just doing. There was a period where any idea they'd sort of put some funding towards it and try something, whereas it's all about being disciplined. Where's it ultimately going to be a product? Establishing that product market fit and sort of getting revenues in. I think also alongside what the fellow panelists also said around talking conversations earlier around access to funding, but also the emerging regulations, etc., sort of how they tie in and really kind of doing a lot of help and support getting those conversations set up so that they can better move forward into the market. So being very active in that sense as well.
And
yeah, one thing I would just add is I think everyone's kind of alluded to this, but make it easy for your investors to help you. So coming up with a list of, your target investors, who you need intros to, having your data room set up, having affordable blurb, like all of the above, so that you should be able to tap into your existing investors. But I know some are less helpful. We are pretty hands-on with fundraising with our portfolio companies these days, but others are not. And so how can you make the most of who's around the table to help you with those introductions? And making it easy is kind of the first step.
And so I know, earlier a few of you were mentioning, fundraising, due diligence is obviously a big part of fundraising. Has your due diligence processes changed over the last few years? And then this person, Oliver, is wondering, at the later stage, are you relying on prior due diligence that's been done, or are you performing your own due diligence? How are you thinking about that, and what are you seeing out there right now?
I mean, speaking for myself, our diligence hasn't changed at all. We always do pretty extensive diligence. I think the time that we have to do that diligence has changed. So now it's better. We have more time to do this diligence. To Matt's point, even at I think he was talking mostly at growth or later stage, but even at the early stage, for a lot of the rounds, there's just more time to get things done and due diligence. And it's not just because there's less capital, but it's also because the founders are smarter and starting to raise earlier before they actually need it. So they're giving themselves more time. So that's been great because it allows us to dig in as deep as we want, and not feel rushed. But the process itself, I don't think has changed on our side.
And Matt,
I mean,
oh, please go ahead, Lou.
I was just going to say, in terms of just building on one of the previous points on, I mean, especially at growth stage, we're doing a lot of work with our portfolio companies, helping them get ready for the conversation with growth stage investors, and that includes, that kind of building out that data room. There's a lot more conversations around the financial model and the economics, so really helping them prep for that. So just in terms of how, and doing a lot of that, introductions and references for them to get the right investors in. But we always do our own diligence, so we don't really rely on previous diligence on our AIM anyway.
And Matt, for the investors that you're working with at those later stages, are they relying on prior due diligence that has been done, or really where are they focusing their attention and efforts?
That's a really good question. Sometimes they will. So a number of companies, as they're looking at later stage rounds, will hire like a McKinsey or Boston Consulting Group, and investors may sometimes try to use some of that. I mean, I think there are really like three different levels of diligence at the later stage you'll have. I mean, so you'll have technical due diligence. Everyone works their salt will eat the product. And then there, of course, is much more in-depth financial diligence that you tend to get in the earlier stage investments. So, for example, a lot of alternative protein companies probably don't have a CFO who's done this at some level. So a key part of the diligence will be, is there a working financial model? Which again, we just don't need at the same level in an early piece. Is there a data room that's much more robust that's in there? If you're raising later stage capital, know that any investor worth their salt will ask for the fundraising deck from your previous round to see how you met up with the metrics that you set out. So I think as you think about when you're raising rounds of capital, call it $100 million or up, or even $75 million and up, you're dealing with a different investor group than you have in the past. They're investing less than the founder, only, less in the product, but more how do you actually get the finances working? And that can often feel like a root canal again, why it really helps to prepare for several months before you go out, because when you actually do go out, you want to be able to own the leverage even in this environment, and then come out to be able to leverage investors against each other, not deal with them one at a time, which is when companies often who are not prepared make a mistake. And what often they sometimes do, if they're going to maybe work with an advisor or someone else, they will have been out of the market themselves. And that really allows the investors to have the leverage and tell part of your story rather than just going out when you can go with your best foot forward. Everything is buttoned up and you've effectively prepared to answer the test questions that they're all going to give you because you've prepared for them in advance.
That's such a good point around the importance of really being prepared and strategic in those investor conversations. And on that, note around strategy, we have a series of questions that I think are more around company strategy if I had to group them. And this is referencing, those long time horizons that we referenced for those deep tech food companies. Do you have any advice for someone? Do you think they'd be better off raising capital with strategic partners in food, or would purely venture capital without that strategic food company be a better bet? I know you can't give specific advice to necessarily a company, but how might you guide a founder through one of those decisions when thinking about strategic funding?
I would be totally on board with bringing on strategics. The more the merrier. Just be careful what you're giving up. So don't sell a ton of warrants or don't give exclusive agreements on things like your access to your technology or your product, right? But for the most part, they're well-intentioned and they're going to add a ton of value throughout the life of your company. So I would always want to have both, personally.
Yeah, I think the key thing there is having both as well, because we've seen, I think, especially a few years ago, there was a lot of companies that only had strategics or were very much dominated by multiple strategics, and I think that can also be a challenging environment just to scale. But I think also we're seeing the importance of life cycle investors. So when that can actually invest across the stages and can really provide the capital as they scale, as being a really useful investor to have on board. So kind of when you think about building out a cap table, just I guess you want to think about all pieces that will kind of last you not just next year or two, but next 5 years. But then also who actually is going to be on the board. So again, in terms of giving up, do you want or not want strategics on the board, which can create complications depending on where you're going. Especially if on the earlier stage, you're not sure exactly what direction you're going in.
Thanks for those insights. This next question's a bit of a bigger one. Michael's asking, how do you foresee the competitive landscape for alternative proteins changing in the next 5 years? And what qualities or strategies do you believe will set successful companies apart, particularly noting that this is a very dynamic, changing and evolving market right now?
I mean, I think in the short to medium term, the thing that's going to set companies apart is their ability to partner in some way with not the incumbent industry, but the leading players that are already established. And the reason I say that is because I'm starting to see that already. I'm starting to see very large companies dipping their toes in the water, and not in like an equity way, not just investing and buying a piece of the company, which we've seen for a long time at this point, but really partnering with startups that have high potential, but have maybe a large CapEx requirement, but maybe the strategic has the ability to kind of handle that CapEx for them in some type of JV. There's a lot of nuance to this, so I'm being a little bit vague, but at the end of the day, I'm seeing the ones that level up to the next stage and grow from being just a startup to being an actual player are the ones that really get in with the larger players and figure out how they're valuable to them and how they can create something that's mutually beneficial in the long term. That seems to be the number one differentiating strategy to me.
I'd maybe just add, in the next 5 years, I expect there's going to be, maybe for the first time, fewer alt protein companies than there were in the past, probably as a result of consolidation and some just natural, healthy companies shutting down over time, right? Not everybody can scale up, but in order to achieve the goals that we have, some companies do need to scale up, and they can only do that through consolidation, or at least that's one viable path to do that. So I wouldn't put too much weight on, the competitive size, the competitive landscape as a measure for the health of it.
Thanks for that realistic prediction, Nate. Luke, Amira, Matt, any other thoughts around what alt proteins will look like in the next 5 years?
I think, we're at this real potential valley of death, unfortunately. A lot of great, amazing entrepreneurs and great investors who've come in and have great technology, great early steps. But scaling, as we've talked about, is just very hard. You need to have best in class science. You need to have a great branding and CPG company. You need to have great supply chain and production. And that's very hard for any company to do, much less a startup. And I think if you look at a lot of these really important technologies, how they've crossed the valley of death, be it Tesla, who received a Department of Energy loan, or others, I think we need to realize that there does need to be some more government support. And this is not saying that there's no private interest. All these great investors on this call have made great bets. There have been hundreds of millions of dollars raised, but it is just very difficult for the investor returns that you're demanded in a higher interest rate environment where there are really strong competing investments out there. So I think if we want to try to shape what's happening in 5 years, we really should get behind other forces of capital to supplement the amazing types of investments that have happened in the private markets. And I think that will really be the rising tide that'll lift all boats.
Thanks for that. So now we're going to, we just thought kind of big picture. This next question is very specific to what should you include in your deck, specifically regarding exits. Do you like to see an exit slide in a deck at the pre-seed, seed, or A round stage? I know there's some controversy out there about how early is too early to start thinking about exits. Curious as to your opinions around including something like that at those stages. And I'll open that up to the earlier stage investors we have on the call.
I can jump in. I don't really see it as like a red flag to include in the deck. I don't think it adds much personally. Like, I spend a lot of time in this space. I understand the exit market. So if it's not in the deck, it's not going to be a flag. If it's in the deck, it's not a flag to me either. It's not really going to sway me either way. However, I think what is a flag to me personally with any founder is just at this stage, in very early conversation, being very focused on the exit from the onset. I think to build a lasting company requires a lot of patience and grit. And if you're from day one kind of stuck thinking about when you're going to exit, I think it's a bit of a red flag for me personally, because it makes it feel like you're not in it for the long haul and you may not, it's kind of just a different perspective. So I don't necessarily know that this pitch deck slide is what sways me. It's the conversation with the founder and how they're thinking about exits from the onset of these early stages.
Ditto. That was very well said.
Right. So now we're going to, kind of move back to an earlier conversation we were having around some of that non-dilutive funding. When we were chatting about that, I will say that the Q&A box was really exploding with questions around this topic. It's really interesting to folks tuning in. Do you think that these sources of funding, the non-dilutive funding, are these more important now than they were 2 years ago? Is it just because it's easier to secure cash this way, or how would you think about that non-dilutive funding now versus 2 years ago?
I mean, I don't think maybe it's more important now because there's less VC capital available. But I think it's just as impactful as it's always been. I mean, selling any portion of your company, if you raise money from VCs, that's the most expensive money you'll ever raise. So avoiding that as best as you can and still making progress by getting capital in other ways, it seems like why wouldn't you do that if you could? I do see more resources popping up in that area, and I also do see more companies that have had time to get familiar with our space better, mainly on the equipment financing side. So my firm has a couple of relationships with equipment financiers that a couple of years ago they were just getting used to Alt Protein, what are the profiles of the companies and the needs, and now they've done a number of deals and they feel more comfortable about what they are open to and what they're not open to. So the process is more smooth. But for founders out there, I would say, like, as you're fundraising with VCs, I'd also like have you flip the question to the investors that you're talking to and say, like, we would like to raise more non-dilutive funding. This is how we're planning to do it and what we're thinking of doing. Do you have an ability to support us in those areas, make introductions there? Because I think that's really impactful.
I think yeah, completely agree. And I think where we're seeing a slight shift is, I mean, I think what's proven out is you can't get to commercial scale just on obviously VC or equity alone. But what we're seeing is potentially investors conversations where they have potential VC arm, but also project finance arm or debt arm, and sort of having that strategic conversation up, or starting that strategic conversation up front, where they might take some money in from the VC with a view that they then could get project finance or debt financing or other forms of capital, whatever it might be, later down the line, and sort of really thinking out that capital plan, probably earlier than maybe it was a few years ago. Is something that's definitely a trend we're seeing, and something that we're kind of actively sort of talking to companies about and trying to understand how that might work to get to that scale.
Thanks, Luke. So another question here, I'll just read this directly. A large number of recent alt protein companies took loans or debt to compensate for the sudden loss of investment in 2021 to 2023. The reason this was cited is so that because the company could no longer get VC investment capital, since so much of that money would then go towards the debt repayment, which I think is a really great point. So at what stage would investors truly want companies to take on debt? If a company did take on debt, is that a red flag for later venture investors?
And I think this maybe ties into Christy's other question. I see two scenarios in which I would expect and want to see a company bring on debt. One is to finance construction of some capital asset, so like a facility, and you'd put together a capital stack that would probably be something like 20 to 30% equity from an investor and maybe 10 to 20% a grant or some kind of loan from a local interest, like your government that maybe wants a facility to be built, and then maybe the rest comes from a lender. And Matt can probably add nuance to how this all comes together, but that would be one situation. And then the other situation would be when a company has cash flow or some good prospect for cash flow, and the debt is used to help working capital and just to kind of get to a bump, but kind of taking debt is a last resort or is an alternative to raising at a lower valuation, I think is very risky, because you could potentially have a debtor taking your company, or you do get the situation where maybe VCs don't want to sink money into paying down debt because it doesn't help them achieve any milestones for growth, right? All that does is keep the company alive, which doesn't help the VC.
Thank you, Nate. And you made a great point. Christy's other question, for those who didn't read it, was that regardless of the type of alt protein company, most will need capital-intensive production facilities and equipment. What stage, what form could the investment community support production of those facilities and that equipment capital? And I feel like some other folks were maybe chatting about some equipment financing that you were exploring. Curious if you wanted to dig into some of that a little bit more.
I mean, anything on the heavy CapEx side is really just historically not what VCs are going to be looking to finance. So that's in any industry. It's not just within alt protein. So that it kind of goes to what I was saying earlier about this idea of structuring up partnerships, JVs, whatever, what have you, with larger incumbents in the space, where for them to build out a $20-30 million facility is a rounding error, if that. So if you're bringing value to the table and showing them why this would be useful to them in some way, then that's a viable path forward. Beyond that, though, the hard thing that's happening right now is just that you're having to try to build these facilities. Normally, these would be financed through project finance, like Nate mentioned, or other lower or non-dilutive, lower cost of capital or non-dilutive funding. But that usually happens in industries where cash flows are understood. The entire market is understood. There's probably legitimate offtake agreements for the facility that's being built. And in this market, that really doesn't exist. This is a new space. And even if there's offtakes, a lot of the times those offtakes are from other startups. So it's what's the value of those offtakes? Can they be taken at full value? Sometimes the market says no. So it is a tough thing to overcome, but I would try to avoid just saying I'm going to raise 30-40 million of VC for a CapEx intensive project. That's probably not going to fly.
Yeah. Matt, curious as to what you are seeing on your side as it relates to debt financing.
Yeah, it's a good point because I think, as Steve rightly said, capital intensive projects are not where VC capital are going anyhow. I mean, and to use equity to finance equipment and plants and manufacturing is really dilutive, and it's not just a great way to do things. So I think the principle of the type of this is where you should be thinking about debt. The problem is if you're looking infrastructure projects, or if you're looking at project finance, you need offtake agreements that are just not where we really are right now in the industry. So I think there's some really interesting creative approaches that have been happening with a number of the CEOs of these companies and some other nonprofits to think about what are some ways we can try to create some of this and think creatively in the finance way to actually do that. And I think that is one of the things, along with the non-dilutive government financing that I was talking about earlier, that I think would really help move the industry forward this year, which I think would be a great collective thing for those of us who are really passionate about the industry to try to focus on and help move forward.
And shifting gears again, we have another question here around various go-to-market strategies, and they're wondering what your thoughts are on the various go-to-market strategies at this point in time. And this person is remarking on maybe some lessons from Perfect Day and the Urgent Company, or from some earlier companies in the space who might have had ingredient contracts at a pilot level and then had trouble converting those into more meaningful longer-term contracts. How are you thinking about those go-to-market strategies now between that B2B side versus maybe that direct-to-consumer angle?
I can jump in. I think a few things. One, in terms of the kind of pilots and B2B side, I think we're, like I said earlier, always glad to see pilots, and hopefully you're getting some revenue from those. But I think it's challenging, and I've heard another investor say this, of getting potentially stuck in like pilot hell. So how do you kind of convert those contracts or convert those pilots into actual contracts? And I think we have a level of kind of higher scrutiny of the pilots that our kind of early stage companies have had, kind of taking those and really doing a lot of due diligence on them and understanding because that to us comes back to what are the corporates looking for, and ultimately what are the other solutions they're looking for. So really getting an understanding of how viable those pilots are, and how those will scale, and what are the inflection points with which those will scale. And then I think on the consumer side, we've talked about this from kind of the public markets perspective, the kind of valuation perspective and the multiples. But one thing that I think about a lot is if you're building a CPG business and you're going direct to consumer, that requires a totally different knowledge set and talent on the team. And I'm always a little skeptical when I see a team of scientists, just being honest, who say that their kind of go-to-market strategy is going to be to build a consumer product. And I feel like there's just a level of kind of ignorance, and in this case, ignorance is not bliss. Like, you really need to understand how to communicate and educate the consumer if that's the route you're going to go. And if you're going to go the B2B route, you need to understand how you're going to convert those contracts and what those corporates are looking for. And I'm not saying you can't necessarily do both, but they're very different skill sets. And I'm always a little wary when I see people claiming that they can do both, especially at the same time.
Yeah, it's very hard with very different skill sets there. Any other thoughts on that question?
Just echoing, I think the cost-cutting piece is having the right team to execute it at the scale. I think the conversion from pilot to commercial scale, where we're seeing, the risk is always the cash goes back up when you don't have the right people to do quality control checks. Waste goes up, etc. And so we're always looking at have they actually got the right people to execute on engineering, and and that comes even more important if you're an ingredient versus a developing a food product. But it is very much about team.
So we have 4 more minutes left today, and so I'd love to take that time to do a round robin of what you all are most excited about in 2024, what your 2024 predictions might be, and I will just go in order of how you all appear on my screen. Mira, would you like to kick us off with this one?
Yes, we're pretty thesis driven at Bluestein. And like I said, we look across the industry. So we have predictions in all of our different buckets, but within food tech, a few areas that we're pretty excited about and watching this year, continuing to look for cold chain solutions. I think there's a drive towards fresher food, more local food, and there's not been a lot of innovation in that space. Continuing to look at food waste and packaging reduction solutions. Obviously, that's a huge issue in the industry. And then kind of toes the line with CPG, but very interested in consumers' metabolic health, as we've seen that's become very much top of mind in the last year with the rise of the GLP-1 agonists. But I think it goes a lot more beyond that with consideration of kind of wearables and food as medicine, and just a lot more mindfulness around consumer metabolic health. So a few areas we're tracking and excited about.
Thanks, Amira. Luke, what about you and AIM Partners?
Yeah, I mean, obviously we've got lots of predictions across all our sectors, but I think what we're probably most excited about in this space, and like I said, we're primarily focused on alternative seafood, is getting some of these FDA approval going through, and I think actually moving to commercial scale on some of these, on some of our companies, and I think that'll be a huge shift in the market when we actually get to commercial scale and some real impact actually happening on the ground.
Love to see that impact. Matt, what are your big predictions for the upcoming year?
I just want to say I think I'm really excited and optimistic about a number of things. I know it's been a tough market, but if we take a step back to know last year, you have the approval of 2 cultivated meat companies to sell in the United States. We've just had another one in Israel. Those are amazing developments, and the science has gotten there. So I think the overall market is very, very hard. And I just don't want us to realize that this is unique to alternative proteins. Like, what's true about alternative proteins, high capital intensity, building very difficult scientific things and needing to get the unit economics right, that shouldn't discourage founders to really make a change. And I'm really excited about that. I would just say, from the dozens of CEOs we talk with, if we can ever be helpful to think about how do you navigate a very challenging environment. When things are easy, everyone can look very brilliant because they really are. When times are hard, you need to really look hard, look at what sets you out from the other areas. And I think, like a lot of here, I personally and Barclays are just very invested in the long term in this. And I think now is the time for us to take a long term perspective. So I'm excited about how far we've come. And just because the capital markets overall in technology are at a rough time, we should not lose faith and lose hope in the critical part that this sector is for the planet. And I think have some real longer term returns.
Thank you, Matt, for that broader refocusing. Nate, what about you? What are you looking forward to?
Well said, Matt. Well, the firm is focused on consolidation and on infrastructure because that's kind of where we see the market is right now. But maybe a prediction and thing I'm excited for in 2024 is maybe plant-based gets its groove back. There are markets and there are categories in which plant-based is growing really well. I mentioned some of them. What are the learnings we can take from those and then apply them to back in the US or whatever categories we're talking about to really appeal to customers.
Thanks, Nate. There's certainly those bright spots. And Steve, we'll let you have the last word here on what you're excited about.
Sure. Yeah, no, I mean, excited about a lot, but I think things that I'm looking for and I think will happen are a lot more companies that are alt protein will not brand themselves as just alt protein, and they'll have something in their business model that taps into other areas like circular economy, food waste, side stream valorization, et cetera. There's other areas within climate that can be incorporated into these business models that could also be like a defensible moat in and of itself, the way they're structuring their business. And then other things are there's definitely a need for new infrastructure and building that out. But I also think that I'm excited to see companies that are trying to optimize current infrastructure more, and just do that in a more efficient way. So make current processes more efficient, more cost effective, and less reliant on needing to build out, 10 billion liters of additional fermentation capacity. So I'm excited about that.
Well, thank you all. There certainly is a lot to be looking forward to in the year ahead, and just want to express my sincere gratitude for all of you for joining us on the panel, sharing your amazing insights and opinions. I know that I learned a lot. I'm sure that everyone else did as well. And thanks everyone for staying with us for this hour and a half. There was a lot of great content. And just stay tuned. In February, we will be having our next Business of Alt Protein seminar all around effective marketing and communications for alt protein startups, particularly thinking about startups in that B2B space. So we'll be sending out an invite for that in the next few weeks. So we hope to see you in February. But again, thank you so much, everyone, for joining us today. It was really appreciated.
Thanks, Audrey, for the awesome job putting us all together.
Of course.
Yeah,
Thank you. Bye, everyone.
Bye.